Good morning, Wall Street. In this video, we're going to review one of our favorite subjects, short interest. In this chart, we're looking at the changes in the short interest for the New York Stock Exchange. The short interest has dropped off an awful lot over the last 5 or so reports. These last 2 periods have seen huge drops in the level of short selling, despite the fact that the market has gone down rather dramatically. And in this chart of the NASDAQ short interest, we again see rather dramatic changes in the short selling, changes that reflect huge drops in negative betting. Now, I'm sure some of you are thinking, well, didn't the government just ban a whole lot of short selling, and isn't that why the short interest has dropped so much over the last couple of reports? The ban on short selling was primarily focused on financially related stocks. In this table, we're looking at all 24 sectors of the stock market, and we've ranked them by the change in the short intensity from the current report to the last report. Yeah, we find that real estate is a financially related sector, which is the largest drop. But look at all of these. You've got media stocks, commercial services, semiconductors, pharmaceuticals, healthcare and equipment and service, food and staples retailing, capital goods, computers, automobiles, retailing, consumer durables, materials, software. So my point is that all of these sectors have absolutely nothing to do with the financial industry, and therefore are unrelated to the ban on short selling, which actually was lifted about a month ago. So this big drop in negative betting, this big drop in short interest, is really a function of the sentiment of the marketplace. And the story of short interest has been a major factor for stock prices going back decades. What we're looking at here is the short interest ratio of the S&P 500 issues. This is the 1987 crash, and you can see that the short interest ratio was a little bit over 1 prior to the crash in 1987. As the market started to recover and go to higher highs, this crash actually occurred in a secular bull market. The 1980s and the 1990s were clearly long-term uptrends for stock prices. There are several things to glean from this chart. With the short interest moving up to the 4 level approximately on this particular measure, you've got what we call an excessive level of short selling. Now I can hear you say that, well, wait a second, the short interest moved up even higher here to the 7, almost 8 level here on the short interest ratio for the S&P 500 stocks. This was an outlier move in terms of the level of short selling. You go back into the prior years, the 4 level was the high end of the range. But ironically, the short selling just kept piling on during the strength of the stock market. And that's a phenomenon of a secular bull market, that the short sellers fight the move until you get near the end. So one of the characteristics of a strong stock market is that you have an uptrend in short selling. And once that uptrend is broken, you now have a period of capitulation in terms of the negative bettors. This whole last move in the stock market was helped by huge short covering as the negative bettors capitulated. The marker of a weaker long-term market is that the trend of short selling is in decline. And that's exactly what we see here. The short ratio with the last report has moved to levels that we haven't seen in decades. And that's despite the weak action that we have here. So both the level of short selling and the trend on a long-term basis remain in a negative posture. Hope that helps. See you next time.